Hi, welcome to today's video. Today's video is on double declining balance of depreciation, probably the hardest method of depreciation to calculate, so please pay attention to the notes and to the problem. So let's first look at the notes. Basically, the double declining balance was established for tax purposes if you look back in the history. The largest amount of depreciation is in the first year and it declines thereafter. Not the same in dollar amount each year. So unlike straight line, which is the same, this is not. We do not want to depreciate below salvage, so we have to watch carefully because salvage value is not in the calculation formula. So that can cause a problem. So most people switch with 2 years remaining to straight line because that way they take care of that issue with regards to salvage. Formula is cost minus accumulated depreciation, which of course is book value, times 2 divided by life. So think of 2 divided by life as a rate. So if the life is 5 years, 2 divided by life, or 5 years, is 40% per year. We'll look at the same problem, the auto that costs $30,000, year one with a 5-year life and a $5,000 salvage value. Year one cost was 30, accumulated depreciation was 0, so book value, which is this, is 30,000 times 2 divided by life, which is 5 years, or 40%. So 30 times 40% is 12,000 in the year depreciation, 12,000. Second year, 30,000, 80 beginning, 12. Leaves us book value of 18,000 times 40%, or 7,200 taken for that year. Add that 7,200 to 12,000. We have 19,200 as accumulated depreciation into year 2. 30,000 less than 19,200 gives us 11,800 of book value times the 40%, or 4,720 taken in year 3. When added to the 19,200 puts us at 23,920. We can only depreciate to 30 minus 5, or 25,000, which means we're almost there at the end of the year 3. So we switch to straight line in year 4. That leaves us 1,080 to depreciate, 23,920 minus 25,000, 1,080. In 2 years, or 540 each year, and we reach 25,000. Most businesses, or the thing to note is that this depreciation expense right here fell below the straight line rate, which would be 5,000 per year if you remember back to that video. So most businesses will sell their asset once it starts to fall below that straight line rate. Then therefore they buy a new asset and get this extra depreciation, and it falls down here, they buy a new asset, and so on. That just is a good way to keep your depreciation higher year by year. So again, basically established for tax purposes many years ago. That was the idea. Largest depreciation in the first year, as we saw, declines thereafter. Don't depreciate below salvage. Watch carefully and generally switch to straight line with 2 years remaining. The formula is cost minus accumulated depreciation, or book value, times 2 divided by life, which we can call that a rate. I hope that answers some of your questions with regards to the slightly harder method, double declining balance method of depreciation. I look forward to seeing you on the next video.